lot of landlords, you've probably set up escrow, so mortgage, insurance, and taxes come out of your account every month. You probably don't think much about them, but trust us. Finding ways to lower any of the three can have a huge impact on your monthly expenses as a real estate investor. In particular, landlords and real estate investors often ignore the control they can exercise over financing expenses. From the taxes you pay to the government to the interest you pay to the bank, you can lower financing expenses from your properties. Most people rarely look forward to doing their taxes, but for savvy real estate investors who understand the power of depreciation and other tax advantages, tax season can be fun. Many property owners are able to lower their personal tax bill by so much that they get money back from the IRS, and what's more fun than that? We could record a whole video series on taxes for real estate investors. Plenty of people already have, but we'll keep the overview light here. Just know that along with rental cash flow, amortization, and appreciation, tax savings are one of the big four wealth generators a rental property offers an investor. Because it's so powerful, it's worth trusting an expert. We strongly advise that you hire a CPA to handle your rental property related tax filing. That being said, you'll maximize your savings if you're in the know yourself. Here's some of the info you should become familiar with. You are a business, not an investor. For tax purposes, the IRS will assign you one of three classifications determined by your behavior and motive. You'll be considered either a business owner, which means you engage in the business regularly and continuously to earn profit, a real estate investor, which means you passively invest and are not heavily involved in regularly managing your real estate, or a property owner for not-for-profit activity, which means you repeatedly report no income to the IRS. As a business owner, you'll have access to a number of tax deductions you would not otherwise have, including the pass-through income tax deduction, home office deduction, net investment income tax, and many more. You should work hard to ensure you're classified as such if you can. It's not overly challenging to do. As long as you're regularly involved in managing the properties or you pay a property manager to do the same, you should qualify. This is also why it's so important to maintain accurate records in the case of an audit. The all-powerful operating expense. You're likely familiar with depreciation, but to give you a brief definition, depreciation allows you to lower the income you received from your property investment and, as a result, lower your tax bill, or in the best case, increase your tax return. The profit you report to the IRS is not based on the original purchase amount, but instead on the purchase price minus any depreciation you've already taken. Operating expenses, in contrast, are like depreciation that's never recaptured. Operating expenses lower your tax bill with no negative repercussions. To qualify as an operating expense, an expense must be ordinary and necessary, current, directly related to your rental activity, and reasonable in amount. This typically includes repairs, maintenance, and other costs associated with running your business. Talk to your CPA about how best to record charges. They'll help ensure you're maximizing operating expenses versus depreciation. It can make a big difference on your tax bill both this year and when you're ready to sell your property. DeMinimus Clause. The DeMinimus Clause is one of the most useful tax deductions available. It allows you to currently deduct any items that cost $2,500 or less each, regardless of whether or not they are an improvement or repair. This allows you to quickly capture the depreciable value of an asset with no future consequence. For example, normally when you purchase a $2,000 washing machine, you depreciate it over 5 years. But with the DeMinimus Clause, you instead take the full $2,000 as a single expense this year, lowering your tax bill without depreciating the value of your property. Again, your accountant should be able to help you navigate through this. Just be aware of it as you make purchases, and you'll be properly prepared to maximize your tax savings. A few other smaller items to keep in mind in preparation of tax season are the home office exclusion, which is a tax deduction that allows you to deduct as business expenses the costs associated with working out of a home office. This deduction is only available if your rental activities qualify as a business, another reason to ensure that's the case. you use your home office exclusively for your rental business, and you use it on a regular basis. The other tip is to track all expenses. This includes any purchases you make, any miles you drive, or any other costs you can possibly record. This will prove useful for two very important reasons. In the hands of a good CPA, it will ensure you minimize your tax bill and maximize your rental property profit, and will protect you in the case of an audit. Challenge your property tax assessment. Every state has property taxes, but the percentage depends on your municipality. Regardless, it's money out of your pocket based on the value of your property. If you have a property that has been assessed at a low value in comparison to other nearby homes, you'll enjoy nice tax savings. If the value is higher than the norm, you'll end up paying more. We're certainly not here to quibble with the first fortunate scenario, but if you find yourself with an inordinately high property tax bill, you may have reason to dispute it. If you believe your assessed value is too large, here are the steps you should take. Act fast. Most municipalities only allow you to challenge the assessed value of your property within 30 to 90 days of the assessment. Check the value of other similar properties. Look up comps. This is likely available on the county assessor's website. This will be the first piece of evidence to prove your assessment is out of line. Consider hiring an appraiser. Depending on your situation, it might be worth it to hire a professional. They'll of course look at comps, but they have a much deeper well of knowledge to pull from, and they'll provide a bit more credibility to the tax office. Request a review. Before formally submitting, call up your local assessor's office. Present your case verbally over the phone first and solicit their feedback. They'll give you a good idea as to whether or not you have a good case and a receptive audience. Once this is done, ask for the official forms and submit your request. Appeal if needed. If the review process comes back out of your favor, your final option is to appeal the decision. This can be a long, drawn-out process, and you may wish to hire a lawyer. If you're successful in changing the opinion of your local county tax assessor, you could enjoy hundreds or even thousands of dollars in savings. Although, if they've got a fair value already, you may end up wasting your time. Refinance. Patience is one of the most valuable assets you can have as a real estate investor, and it's not limited to buying and selling properties. When you own a property, you can always refinance to get a lower interest rate on your mortgage. When you refinance your mortgage, you take out a new loan to pay off the original loan. If you've built up a significant amount of equity, this can also be an opportunity to cash out some of that value for other investments. The new loan will bring with it a new interest rate, and if it's lower than your current interest rate by a sizable enough margin, can save you a lot of money. Refinancing does mean a new loan, which means new closing costs, so be aware of what that will do to your potential savings. Most banks will let you roll the closing costs into the new mortgage, so if you're lowering your monthly payment by even a couple $100s, it's likely worth it. Most believe that it will be worth it to refinance your property if you can lower your rate by 0.5% or more. Any less, and it depends on closing costs and the time it will take. Any more, and it's a no-brainer. You have more control over your finance-related expenses than you think. Whether you want to refinance to a better rate, push down the appraised value of your property, or beef up your tax game, there is plenty of room to find savings outside of the traditional routes many real estate investors normally go to. You're running a business and you have opportunities to lower the cost associated with the capital that the business uses. Don't forget it. It can mean big savings. Thanks for watching and happy renting.